All right, so I'm just going live today. I'm not taking any live trades. I've already taken three trades in a week. So this trade account right here, you can see is a paper account. Um, Trust me, if I had this much money in my bank account, I would definitely not be doing what I'm doing. Literally had a trade here where I flipped 100,000 into 150 million. It's not real. But so just, if you see that, But um what I want to just kind of draw out here is basically just a quick overview of what happened today and really what happened the rest of the week. And so this week has really been a bearish week. And so you can kind of see, again, if you trade ICT or smart money concepts, you can see kind of like the breakdown here. If you trade more traditional concepts, you can see this is kind of like a head and shoulders pattern. But really the draw on liquidity was this sell side right here. And you can see that there really was two trades that I took this week. The first one was this trade on Monday. Really, my only trade of the week was Monday. I ended up taking, was it Tuesday? Maybe it was Tuesday. Yeah, it was Monday. Sorry. So the only trade I took this week was really just we had a very clean run over the highs of the most recent swing high here. And again, you can see if I go to the daily time frame, coming into the week, I expected the market to be at least bearish, Monday, Tuesday, trade into the gap and then be long the rest of the week. I thought potentially we were going to trade into this gap. I thought worst case scenario, we would take this low, this sell side liquidity that was resting there and then trade away from it. And so ideally, again, I thought there's two levels that I thought we could run to. Again, this fair value gap, which is actually much smaller than the daily, it's right there. But then this secondary sell side as well. So that's kind of the big thing that I've been watching is like where can we run to eventually turn around and run higher? We know long term we're probably going to run higher. And so this was the overall draw on the liquidity for the week. If I go to the weekly time frame, you can see here we also are trading inside of a weekly fair value gap right there. And so ideally, again, want to see the market could tend to go up from here and respect this. If we honestly, if we invert this, then I mean we're looking here or some level in this range which could be bad. I've seen this kid on social media. He caught the low of this, and he's in with seven full Nasdaq mini contracts. And at this point up here, he's holding to the all-time highs, which if he makes it, he'll make $500,000. But he was currently around here and up 300,000, and I mean that's good for him because if I'm up $300,000 in a trade, I'm retiring for the year. So. But good for him that he's holding it. But he's definitely probably going through it right now because he's probably lost at least half of that, or at least a good $100,000 in the last couple days. So either way, that's the game. So ideally, coming into the week, again, the trade that I took was basically just a run over the old highs. Um, right. And I figured we would come to this level here, maybe trade in this gap and then turn around and go higher, but obviously the retrace was deeper. So knowing that Monday was probably going to be a trade against the trend day, right? I expected the market to want to go lower. We came to the terminal at beginning in New York and it saw really the market had already taken the high and there's a couple levels here. So I kind of knew the market was ready to come back down. So we have the Asian low here. These are relative equal lows, right? We also had the market take the high, set an initial high in London session, which is around the 3 o'clock window. Towards the end of London, we traded into taking that high one more time. So I'm just going to mark this with buy side liquidity. high of the day, and then we crashed in the New right before New York session. So I kind of figured coming into New York, one of two things was going to happen. We either were going to take this new high, right, which would have been the current high of the day at that point, or we were going to fl probably retrace to some level in this and then go lower, right? And so I was kind of nervous at 9:30. If I go down to the 5 minute time frame or replay this, let's go down to the 5 minute time frame. So 5 minutes, that's prior to the market opening up, I kind of outlined two levels. I outlined this fair value gap here on the 5 minute, and I outlined this fair value gap on the 5 minute, because really those were the only two things that I could see the market at that time. And I'm gonna go back a little bit more. Could take. So prior to the market opening up at 9:30, this is all we really had, right? And so I was like, all right, well, if we're gonna run higher, then we probably gotta get some buy side liquidity before we take these lows. We'd already taken the low of this. So usually when I come to the market and I say, okay, we've taken the high, we've taken the low in the direction, excuse me, in the direction that we want to see for the day, then most likely this is kind of letting me know that the market is kind of tilted in my favor, that the market's going to continue to go lower, right? So again, you already saw the power of three. This is kind of like our continuation play. Um, and so I marked out two levels and I couldn't really see anything on the 30 minute, couldn't really see anything. And I didn't go to the hour at that time. So I didn't look at the 30 minute. I was really looking at the 5 minute and the 1 minute. And this is probably where I took an L to start the trade off. And probably if I had noticed this, I probably would have adjusted a little bit better. But that 5 minute gap was inside of a bigger 30 minute gap, and I wasn't looking there. So really, all of this was a bigger 30 minute fair value gap. But I was really focused on the five. So again, as the market opens up and plays out, I saw this. Saw a couple of things here. At 9:30, we saw the market spike up and take this level. I'm gonna go down to the 1 minute time frame so you can see things a little bit clearer. So we saw the market spike, and as soon as this broke structure here, I was like, all right, we're probably running lower. So I was in with my entries somewhere around in this range. And once we traded into this gap and then closed below the second gap, I was like, all right, it's go time. We're probably not running back up there again. Little did I know that there was another gap. So initially I was in profit, ended up getting stopped out because right now my account has a setting on it that if I'm down more than I think like 1K in a trade, it just cuts me out, and I'm cool with that. It allows me to kind of reset and kind of take, take a step back and say like, do I have the right trade here? Is this the right idea? And not just hold on to the trade for the sake of being holding on, right? So cutting losers, pretty quickly. Honestly, it probably will take that loss down to like 7 or 800 in the trade. So. Um, so we were chopping right here, right? And we had like an hour of chop. And again, if you know chop, right, we know that chop is really just consolidation. So really, when I saw this, I was like, all right, this is just bigger consolidation. So we swung, took that low there. I like what's going on. But in the bigger picture, I'm still like, okay, we took the high of the day, we took the low of the day. It is NFP week or FOMC week. We could just chop for the rest of the week. Or we could, uh, go lower, right, in alignment with the overall trend, right? And usually we kind of have a bias for the day and a bigger, longer term bias for the week. And this is the pullback, which I thought was going to turn around and be bullish towards the end of the week. Um, again, if we have a directional bias or an anticipated bias for the day, then I know that sometimes consolidation is just the chop before that move continues. So we had this. And so it was in profit. We came down here, and I want you guys to kind of look at some of the signatures in price. We had how many hits to the low? We saw we came down here, took that low once, closed right back below the Asian low. We came down there twice, ran right back up there, came down there three times. When I saw this, I was like, okay, this might work against me. And I was really holding this because I thought the longer term play was going to be this gap right there. So I ended up holding on to this trade probably a little too long. I think I was up $1,000 at one point. So at this point, probably should have moved stops to break even at least. So whatever, the loss was contained. So again, my stop loss was sitting above this high here. And so again, had I looked at the charts and noticed that there was a 30-minute fair value gap, sooner I probably would have done one of two things. I probably would have either A, moved my stop to break even, or B, uh, you know, move my stop a little bit higher just to make sure that we were okay. So basically what happened is the market again traded into this 30-minute bracket structure, and this is just a higher time frame version of our setup. Again, when you notice the sweeps that we had the falling apart, we had the break of structure here, and then we had the fair value gap open up. We also had, again, now unfortunately for me, we had another area of liquidity which happened to be where my stop was resting, right? So within this, and again, I talk about that pain pocket example all the time, right? We know that the market is broken structure and we have to distribute to the sellers that are below the lows for the day, right? So we know that when the market opens up, especially since we had all this pre-market action already and the market's just ready to go down, it's looking for the buyers. So it spent 30 minutes to an hour chopping to generate liquidity, right? In this case, I was unfortunately somebody's exit liquidity, right? And so the buyers are sitting above this high. Right. In this case, this is where I was at. So, the buy stop sit above highs, took me out the game, and then obviously traded in this gap where we know there's going to be more buyers, right? And more positive buy, buy orders. So within that, again, the market came up, took me out, and then I noticed that, and I jumped to the 1 hour time frame. Really, I caught the 1 hour first, and I noticed that we were trading within this gap here, and I was like, ah, shoot, I messed up 'cause I didn't see this, and so user error, right? And so once I saw the market reject from that, and it did a couple of things, and not only did it trade into this gap, and I'm going to get rid of this for the time being, but it also closed below the wick of this previous level. And so anytime you see the market run up above an old high and then close below it, essentially that's a variation of the structure that we want to see, right? A sweep of liquidity, lower time frame break market structure, right? And I guarantee you that this candle right there, that wick up was a fair value gap entry somewhere right there. Right. And so again, sometimes you don't even need to go to the lower time frames. You can see what's going on here. Anytime I see the market run above an old high and immediately crash, I know that we had a break in structure at some level, right? And so this is basically what we saw here on the 50, on the 5 minute, and the market was failing to really stay above this old high. So 1 5 minutes, 10 minutes, 15, 20, 30, 45, or 5, 10, 15, 20, 25, 30, 35 minutes in this range, and then the market tanked. And so as soon as I saw that breaking structure, I was like, all right, we're definitely good. So I think I re-entered somewhere around here in the 60 range. I think I was a little bit smaller on my 1 minute time frame and kind of noticed this. So I was like, all right, boom. I think as soon as we took that, I was back in. That was a little risky based on here because we could have just chopped and went higher. But the 5 minute gave us a very clear break in structure. So I was like, all right, cool, we're probably good. Um, if I'm gonna go back, where are we at? Yep. And so at this point, the market really started to just tank from here. And it tanked and tanked and tanked. And honestly, I think we got to the point where I was out somewhere around here. I think I was out at 1 o'clock for a 3K day. It was a very long day. I had 15 micro contracts on. I walked away with 3K. I'm sorry, I think I walked away with 4K on the trade, 3K for the day. So it was a really good setup. I think yeah. And that was pretty much my only trade of the week, right? And so coming into this week again, knowing that FOMC is big, knowing that I made $3,000 already this week, there was no reason for me to like really jump the gun and hop back in, especially with the market conditions. And so fast forward to right now, we can see what's going on right now. The market is really struggling to take the low, right? And I wonder if I put up ES here again, knowing where we're at in the week. Huh. Wow. ES is not taking the low of the day. It has not even gotten back to the midnight open. So this is a little bit of divergence here, right? So if you look, you can see my mouse moving on both charts. This is the low of the day where we're currently resting. And notice how Asia has been swept and it's really having a hard time staying below Asia and like not. This is our Asian range on NASDAQ. We're really having a hard time getting below that low. And then if you look at yes, we are nowhere near that low, right? So this is kind of letting me know like we're actually still above the high of Asia. So it's actually really interesting. This could be a sign of divergence that there was orders below the low that ES needed to get, and there's not those same orders there on. I'm sorry, there's orders below that NQ needed to get, and there's not those same orders in ES. Um, or it could just be holding for another rundown. I think that's really interesting. We took out. Yeah, it's really interesting. We really take out an hourly or session low. But yeah, so you see this here. If we go to the 1 minute, you start to see chop. And this could just be like the market trading back into the range. I want to see how it reacts at the midnight open. Overall, though, this market basically opened up and immediately dumped at 9:30. There was a slight run up right prior to 9:30, and it was kind of a similar situation as Monday, where we had already kind of broken structure and took in the highs that were set in pre-market, right? So you can see again a run up there. We had this inverted fair value gap that really served as kind of like the structure that market was respecting. It broke, inverted at right before 9:30, 9:25. We snuck up in there and then immediately closed again bearish. And so then we just dumped from there. So I mean, this could have been a tradable day. I mean, it would have been a lot just like Monday's trade. I watched it happen and I was kind of like, I don't really feel like risking this because again, Friday is supposed to be our counter trend day. So in theory, I actually had a bullish bias coming into the day. And maybe we could, overtake this and run right back up there. But I was like, I don't want to risk that. Um, you already got a good week. I hate ending Fridays bad, right? And so that's kind of my big thing is like I don't want to end a Friday bad because it carries over into next week. So a lot of times I won't even trade Fridays. If I do, then it's lower volume and it's not going to mess my week up. Um, and again, especially the days where you have a clear expected bias for the day. If I had to guess what's happening right now, though, we've consolidated, we've manipulated, we've distributed. If I was going to go short, it would probably be somewhere right here. Seeing if we could take that and continue to go lower. It's Friday though, and I don't want to play around with that. And I might watch this, but there's no reason to participate today. So I'll watch this for a couple more minutes. If I was trading again today, again, remember keeping in mind today is Friday. We are at the low of the week. I mean, this is pretty much the low, right? Um, And this all of this price action was really just to come back into this weekly gap. So that's kind of the level there. And really just want to see again, can we are we gonna keep respecting this level or are we gonna run higher? So if I had to take a trade right now, I would probably say like, and I'll probably paper trade something just so we can get an example here of what I would do on a Friday. I'm gonna so so really let's just have some fun with it. 50 contracts of micro, the micro right there. Stop loss. I'm gonna put my stop right there. And what am I aiming for? Well, I'm aiming for this 15-minute fair value gap right there. I want to see how the market reacts to that. Why I'm on the second charts because I'm dealing with, I mean, I guess technically it's not a high, not a big contract, but for this amount of the account, I mean, it's like literally $150 million in this balance. But I want to be able to annotate stuff and see what's going on here. So what do we have here? So we swept, took out Asia's low. Now I want to see if we can run up and see if this was kind of like the false move to get this session going, or at least back into this gap here. We'll stop out there. But again, this is more the reason why I don't trade on Fridays is because of this. Uh, the bias is usually going to be like opposite of what's happened all week. But when you have strong days like Fridays, I mean, like it's sometimes it's easy, like it's hard to bet against the idea that the market's going to keep flushing, right? What I can say is we've swept this thing now 1, 2 days. And we probably will close back in the range for the day, but it's kind of hard to predict. And so, again, your optimal trading days are really going to be Tuesday, Wednesday, Thursday. You know, those FMC, non-NFP weeks. I mean, it's going to be your Monday, Tuesday, Wednesday, right? So I'm gonna try this one more time. If we sweep and break structure, so we're trading into this low, taking out the sell side below this cluster, and then we're running back up. So, right idea, just wrong time. Cool thing is sometimes you can have some fun with this. All right, so now I'm down to the 15-second time frame. A time frame I usually wouldn't be on because I don't usually don't have the package for this. But I do now because I accidentally had to buy it. So let's have some fun with it. So again, it also gives me more examples to show. Um, so once you have a defined target, right, it's a lot easier to be able to project, add contracts. So you see how we just traded back into that gap? I'm gonna pyramid this and I'm gonna add 25 contracts more. Gives me a reason to say like, okay, cool. And the reason I'm adding to that trade is because we have a defined reason, right? And so now, based on the 15-minute to 30-second time frame, we have uh, there's a reason for us to continue the bullish momentum, right? We traded into this old gap, picked up some sellers, picked up some buyers, and we're distributing to the highs. So yeah, so that's the first thing I'd say. Again, and then it's just kind of monitoring and measuring the trade out as we go, right? So why do I think the market's going to continue to go higher? This is a good way to practice, especially in the small time frames, because it happens so quickly. You can literally get thousands of reps in. So what do I want to see happen here? Well, we have this fair value gap. We have this order block right here. And so what I want to see the market do is trade and stay above consequent encroachment, which it just did not. Now, what else is in this range that could act as, I guess, technically support? Well, we have this fair value gap here on the 30-second. So making the picture bigger so you can see what's going on here. This is a very crazy, crazy defined small range, right? Because if you zoom up and go back to the 1 minute, what do we have here? We have the market broke structure to the upside still, remember? And we traded back into this order block. I'm gonna get rid of this. Traded back into this order block here. And usually what I do is if there's more than one down consecutive candle in this in a run, I usually use both. So if you look at the measurements of the bodies of this to the high end of this, you can see that we were just below consequent encroachment of this fair value gap. There's a lot you got to measure here. So if I wanted to really pyramid entries again, I could literally add another, I'm gonna probably add 12 this time, just off of the strength that um that has that rejection shows us, that we're in a good spot. And going back down to the 15-second time frame, you can see we've broken structure and we went higher. So this market is giving us good structure, right? Especially in some very small time frames. But again, when you think about like how people trade with algorithms and like machines and do a lot of the trading now, this is what they're doing. They're executing on very small time frames, like 5 second, 1 second, 1 second, 5 second. And instead of having a bigger time frame target of like all the way up there, they'll keep taking every bullish break of structure till it hits the bigger picture, which is like somewhere up here. I would not be surprised if we didn't take this high. And they're adding, getting in, getting out, adding, looking at these mini targets. Okay, so this might be our 30-second target here, right? And every 1 second bullish thing that it's doing, it's finding opportunities to scale in, right? And so that's how these bigger, these corporations and these hedge funds make crazy amounts of money on one run. And it's done in a safe way. But it's a story for another day. My ultimate goal with trading is to be able to make an algorithm that does this on the very small time frames. Um, See how we traded back into this wick here. So again, wicks are kind of like gaps. And I'm doing this is moving a lot faster than I'm really used to because I don't really be this slow. So again, when you think about gaps on wicks, right, especially these order blocks, same idea exists here is that a gap. A wick is kind of like a gap where you don't really want to see the market trade into the lower half of that wick. And so what did it do right there? That's the half. It traded below it, immediately ran back up. That could be another entry, right? It's another bullish confirmation. What do we have here? It's a very, very small fair value gap in this range, like very, very defined. Let's hop back up to the 30 second. Same wick, pretty much. See how it respects it. And then this order block there. This is the fun stuff. Like when you can get, see how it immediately close right back above it. All this stuff is algorithmic. It's a big computer game, right? And so when people talk about buyers and sellers, like selling pressure, it's not that. It's literally an algorithm that is distributing orders and moving back and forth based on where the orders are at for the day. And so if you understand the algorithm, you can understand trades. It's not as complicated as people think. If this thing was so complicated, then like everybody's 401ks and pensions are tied to these two, three, four, five indexes. If this market was as complicated and as random as people thought, nobody would make money consistently. So we're about to, this is a civvy, right? It's a fair value gap that's inverted. Notice the bodies are staying within this, so maybe that means that we're good. I'm already up $3,000 in the trade, so really want to see how the market reacts to this. Do we contain in this? And notice all this action is happening where? In alignment with that wick. So this is very, very, very fast. I mean, honestly, this is probably way more faster than I'm comfortable with. If there was money on the line here, I probably would be freaking out a little bit because I'm used to just 1 minute stuff. But if you go back to the 1 minute, what do you see here? Right? There's no reason to be out of this trade. And so what I'm doing is I'm constantly adjusting time frames to see. I'm gonna take another 12 there. What I want to make sure is that we stay above this high because I want to make sure we're not sweeping this high to go lower, right? So that's $6,000 right there. At this point, I would move my stops to break even because we're kind of there. What I don't like here is the fact that we've already this gap is still open and we haven't traded into it. So that's what I'm watching. And I want to make sure that we don't sweep and come right back below this high. So now that I've done like two consecutive sets of 12, and notice how the lot size is getting smaller, right? The contract size that I'm using is getting smaller. And so this would be the equivalent of having 10 full contracts on, I believe. So what do you see here? Well, on the 15-second or the 30-second chart, I see another bullish civvy. And sorry, I've been marking these colors wrong, right? These should all be green, except for this one. This was actually should be bullish. So let's go ahead and move this stop up. Now this is in profit for the day. It's currently sitting at about $8,000. This gap is wide open. This is kind of like my last line of defense. If the market inverts this, then it's probably letting me know the market should not should run lower. And so that's why, again, a good place to put your stop is you want to move your stops to areas that if the market takes them and closes below them, then you probably are for the rest of the move or the move is done, right? So trade back into this range. Notice how it tapped consequent encroachment right there. After a while, this stuff is just like rinse, wash, repeat. This cluster right here is probably a higher time frame order block right there. So now you're safe because notice your stop is sitting below that 1 minute order block. So there's a lot going on here, right? So I would say this is 1 minute OB, minute OB. And I want to see, again, the same thing that we've seen on the lower time frames, the market react to that. That's technically another entry. So this is going to be my last one. So what do I want to see here? I want to see the market stay above this wick. And so I'm going to get rid of this. And so what am I watching? I'll go back down to these more time frames. I want to see the market stay above consequent encroachment on the 15 second. You go to the 1 minute time frame here, you can see the market failing to really go higher. We did sweep the high, so that could be tricky. And then I want to go back and see if we hit our 15-minute goal. We did. We hit our 15-minute goal. So I'm going to move. I'm actually going to close this out here because I didn't realize that we hit our overall target, which was this 15-minute gap. So I'm going to move stops up and I want to see like how we react to this level, right? Are we sweeping it to go lower? We did take out that high right there. Are we sweeping it to and going back below, or are we running higher again? Looks like we're running higher. So I'm probably gonna go to a smaller time frame, move my stop up a little bit more right there, right there. So what's happening in a 15-second time frame? Again, we just traded into that fair value gap right there. So we are running higher. We're closing below that. I don't like that. So I'm probably gonna move my stop up a little bit more. Again, I'm being really conservative when you have this based on a 15-second work. Um, there's a gap down right there, but the market is still staying below or above the consequent approach from that 15-second time frame. So all this stuff, same thing, right? The way that my mind kind of works with this stuff and the way that trading works is kind of like if-then statements. If we stay above here, then we have a likelihood to keep going higher. If we close below, then the market is likely to do this, right? And so it's a computer program, it's a computer algorithm, right? So 30-second time frame, see how the market is this huge. It's a lot of quote unquote resistance with these two order blocks that are sitting right there. So I'm up 9,000 right now. I'm gonna move my stops a little bit higher. 7,000 right now. And if you look at, it might take me out right here, and I'm cool with that. Where did I move my stop to though? Again, consequent encroachment of this 30-second order block, just below it, right? If I measure this low to high, you're gonna see that we're sitting right there. And we just missed getting out. We got taken out right there. So it might keep running higher. That's cool. But again, being able to, it's not about getting the high or the low of the day and trading all the way to that. You're never going to consistently get that. It's about being able to frame out a potential target, a high or low of the day, and trade to that target and then manage the trade once it starts going in your favor. So what's the order today? Um, it's the balance. Yeah, so $7,000. That was made in like 10 minutes, 15 minutes. Right. So being able to do something like this repeatedly is good. I mean, honestly, going to the smaller time frames, it makes you a little bit more disciplined and trained for the 1 minute and seeing things a little bit clearer. Um, Here we hit that 15-minute target, but see what I'm doing? I'm managing a bunch of different things. So we had an overall target or overall draw on liquidity for this bullish run. Right? We knew there are buyers in here that the market might potentially want to go get before the market turns around and starts going lower, which is right there. And so we were able to basically build the idea for a counter trend run based on that. Now, I could take this and go short again based on the overall structure. Overall structure has been bearish. Could we potentially, use this as an opportunity to take this and go lower? Maybe. I would need to see some type of break in structure, right? There being some, and we're getting that right now, 30-second time frame. I want to see a very clean 1 minute break in market structure. So if we take out this low, where it's very obvious, like maybe the market trades back up into that, then I would want to run lower. right? And on days of volatility, you can really run up, something just because the market's showing you what it wants. And so if I go 5 minute, I'm good here. This is what I would end. But if I was trading today and I actually had, now obviously this is paper, right? So I'm doing some things here that I wouldn't normally do. Again, I'm more of a take the market open person because it just has the most volatility and the most opportunity to be right. Usually my trades after 10.